think about what it actually means to hand over your life savings to a total stranger. You spend decades trading your time and energy for a finite pile of capital, and then you have to entrust its survival to a financial institution. The emotional stakes of that handoff are staggering. Financial regulators understand this vulnerability. To manage it, they require wealth managers to categorize their clients based on their financial knowledge and experience. For everyday people, that classification is known as a retail investor. This diagram outlines the core logic behind those client categorizations. There's an inverse relationship at play. Investors with the least knowledge and experience are legally afforded the most protection, sheltering ordinary people from taking on cataclysmic losses they don't fully understand. This protection manifests as a legal standard known in several jurisdictions as a fiduciary duty or regulation best interest in the U.S. Under this rule, a broker or advisor is legally barred from placing their own firm's profits or interests ahead of the retail customers. But a major practical problem arises here. An advisor cannot legally or ethically act in your best interest if they don't intimately know who you are. To provide that legal shield, they have to perform an invasive investigation into your life. This infographic shows the 6 distinct stages of the financial planning cycle. It forms an ongoing loop, from establishing a relationship through to implementing an action plan. The entire process hinges on Step 2, gather data, or KYC, extracting mathematical facts alongside subjective opinions. Take a client's health status. If a client comes from a family with members who live until a very old age, their strategy requires a heavy exposure to equities to ensure their money outlives them. Conversely, a client in poor health requires a totally different approach, shifting weightings toward cash and fixed income assets to generate immediate, safe returns for care. A person's occupation creates unique obstacles too. A high-ranking corporate executive faces strict regulations regarding insider trading. To avoid criminal liability, an advisor might need to set up a blind trust, an arrangement where investment decisions are taken on a totally discretionary basis, deliberately keeping the client unaware of where their money is moving. Then the advisor has to map out family commitments and monthly outgoings. A standard practice across the wealth management industry is to set aside 6 months' worth of living expenses in cash reserves. That creates a highly liquid buffer, ensuring the client never has to sell off assets at a loss to cover groceries during sudden market volatility. KYC functions as a comprehensive psychological and financial autopsy, diagnosing the specific vulnerabilities of a client's current life stage that a simple compliance form would miss. All of that harvested life data serves one primary purpose: calculating a client's individual risk profile. Often, people talk about financial risk as a single trait, but an advisor actually breaks it down into 3 entirely distinct metrics. Pillar 1 is risk capacity. This is the cold, unfeeling math of the situation. It measures the physical ability of your current wealth to absorb a severe financial loss without destroying your day-to-day standard of living. Pillar 2 is risk tolerance. This is purely psychological. It measures the degree of uncertainty you can handle emotionally. If your portfolio value drops 20% overnight, risk tolerance asks whether you can sit on your hands and wait for a recovery, or if you will immediately panic and hit the sell button. Pillar 3 is risk perception. 2 clients looking at the exact same volatile asset will judge its danger completely differently. Those subjective judgments are heavily warped by a person's individual knowledge, their cognitive biases, and their past financial traumas. This table breaks down how an advisor evaluates risk tolerance by separating objective and subjective factors. They have to weigh hard facts, like a client's age, wealth, and timeline, against soft facts, like their psychological makeup and how severely they regret bad decisions. A functional risk profile represents the precise intersection of mathematical capacity and fragile human emotion. Often, a client's risk pillars will directly contradict one another. You might have a highly wealthy individual whose balance sheet shows massive risk capacity, but whose severe personal anxiety leaves them with an incredibly low risk tolerance. When that misalignment happens, the wealth manager's mandate is clear. They must build a portfolio constrained by the client's lowest risk denominator. Even if the math says the client can afford high-risk growth, the strategy is anchored to their comfort level. ensuring they won't make catastrophic, fear-based decisions the moment the market takes a dive. The modern wealth advisor operates primarily in the realm of applied behavioral management, subordinating market predictions to the realities of client psychology. Delivering true financial advice is an act of translation. It takes the volatile, indifferent realities of global markets and maps them to the complex, deeply personal reality of an individual human life.